Welcome to the Rose Show podcast.
Thank you for joining us today. I'm Rosanna, and I'm here with Aahan Menon, founder of Prometheus Research, a research service that makes institutional quality insights and provides macro analysis that's insightful and actionable. It's the democratization of research, of macro research. And Prometheus accomplishes this by dissecting macro data in the US and then uses a rules-based quantitative approach to translate this analysis into portfolios. Thank you so much for joining me today. How are you?
Hey, Rosanna, I'm doing well. It's great to be here. Thank you for having me on.
Thank you so much. So we met up a few times in the past on Twitter Spaces, and I'm so grateful to have you on my podcast. Lots has changed since our last meeting in late 22. And you also launched your ETF, which I'm so excited to talk about a little later in the show in greater detail. So let's begin. For everyone, all the new listeners, tell us about Prometheus Research and its unique approach.
Yeah, thanks. So what I think we do at Prometheus that's relatively unique to what happens in traditional macro is that we spend a lot of time trying to understand what's happening with the economy and with markets. And, that involves very typical kind of macroeconomic analysis of major economic drivers. But I think what really makes us different is we then spend a lot of time trying to codify that understanding into a systematic rules-based process. So we take our observations about how things work and the way we think that cycles evolve, and we codify that process. And that allows us to create, an approach where we can look through history to see whether what we've learned in current context is applicable over history, giving us a better validation of what we think is likely to come. And so, we spend all our time basically iterating through this process of first we go out and we study what's happening in current context, then we go and try to say, is there something that we can extract that's valuable and systematize it and then test it over history, and if useful, we add it to our existing body of knowledge. And that's kind of, what we do at Prometheus that's very unique.
I love it. I remember you telling me how it's also figuring out how stuff works based on understanding the underlying mechanisms rather than just analyzing data like many others do. So that's very unique, and I love that. So let's dive right in to the big topic. Last time we spoke, it was stagflationary nominal growth. Now, as you recently said, is the mirror image. There's been a shift from inflation volatility to growth volatility. So now we're on a path to a disinflationary nominal growth slowdown. Could you please explain what your systems are seeing?
Sure. So I think to kind of put this into context, last year we had a situation where we had a very, very heightened nominal growth situation, right? And what the reason we called it stagflationary nominal growth is because most of the growth we saw last year came from just explosions in prices. And so as a result, you had nominal activity, but the tilt was definitely towards inflation. And now what we think we see happening is not that the inflation is going to disappear. So I think there are different levels to this conversation. So the first level is that when we look at growth rates, inflation is not going to disappear. But what we do think is that we are going to have a compression in the amount of inflation we experience. And we can probably get into that in more depth. But what we're seeing is that we're going to have a compression probably in this inflation stabilizing at a lower level than what we experienced in 2022. But at the same time, we're looking at a situation where economic activity is on the verge of and maybe potentially in the near future going to start contracting. Real output will start contracting. And so when we think about that, what we realize is that what moves markets is not so much just the stable rate of things, it is the volatility and the change of things. So what we're seeing in 23 is much more likely a situation where growth volatility will be the dominant factor that moves asset prices relative to inflation volatility. And so even if we go into a recession, we're looking at a recession where, you could go into recession where, say GDP is like -1, but inflation is 3, 4. So there's a stagflationary kind of tilt to the recession, a prospective recession. But at the same time, what markets necessarily price isn't going to be the level of inflation. It's likely to be the volatility of inflation, which is compressed. So what we expected going into 2023 relative to 2022 is that from a market pricing perspective, you're going to have the inverse of what you saw last year. And so far, we've started to see some of that. So if you look at a joint portfolio of stocks and bonds, which is essentially just a bet on either inflation coming down or inflation volatility remaining constant and growth volatility being the dominant driver, you've actually seen quite positive performance year to date. And now we're very in early days. But I think that we're starting to see the initial indications that we're moving from this stagflationary nominal growth market pricing to potentially a disinflationary nominal growth market pricing.
Very interesting. So this shift would imply a transition back to a regime of disinflationary real growth. And I'm noticing in your ETF, and which is a fantastic ETF, that your regime is actually has a probability of 1 month of decreased growth. I think that's the highest probability, and decreased inflation. However, the market implied probability is different. Could you explain those differences?
Sure. So what we're looking at is different durations. So we're looking at if for the listener who doesn't have the visuals in front of them, what we do is we use these things called market regimes, which is basically our extraction from markets, what we think they're pricing in terms of growth, inflation, and liquidity. And so, over various time horizons, we can say that, markets have priced, X regime with a certain probability. And what we've seen over the last month is we've seen, first off, we've seen a very high degree of pricing of what we'd call, a rising growth and falling inflation environment. And more generally, what we've seen over the last few months is that the probabilities of falling inflation have increased quite significantly. And this is just, a little bit of confirmation of the broader kind of picture that we've been painting.
Interesting. Thank you so much. And as you said, this picture implies a much easier period for stocks and bonds, which we have noticed this month thus far. Let's go to the monetary and fiscal policies, which continue to be contractionary. However, increased credit creation by the private sector has offset this somewhat. But this offset seems to be transient. Could you please explain that for us?
Yeah, sure. So there are two dimensions to policy, right? And policy is obviously really important for asset markets on a number of different levels. So there's fiscal policy and there's monetary policy, right? And so monetary policy is fairly straightforward and well understood. Monetary policy happens through interest rates. And so we've had a lot of hikes happen in 2022, and we probably have a few more that are happening in 2023. And what is likely to happen when it comes to the interest rate front is that the Fed is unlikely to push further rate hikes beyond, say maybe 525, maybe 550. And so what we're going to get to is the point where the Fed is likely to lean on the duration of holding rates high rather than continuously hiking, unless we have some sort of resurgence in inflation. So what we can expect, and now what happens with interest rates, is that the impact on asset markets is fairly immediate, but the impact on the economy is slow. Because what the hiking of interest rates really does is it doesn't make existing debt service payments that much harder, because a lot of debt that's actually created in the United States is fixed rate debt. So as a result, even if you have higher rates, it doesn't actually translate into higher interest burdens. But what it does impact is it impacts new credit creation, right? And so as you move through the cycle, you slowly start to have, less and less credit creation, especially when you have a situation when nominal activity is coming down and an interest rate is kind of staying stubbornly high. On the other side of monetary policy, they're also doing something called quantitative tightening, which is essentially just taking liquidity out of financial markets, right? So what the government is doing is they are reducing the size, the Fed is reducing the size of its balance sheet, which effectively reduces the amount of liquid assets that are available to the private sector. And as a result, that tends to be a net drag on risky assets. Now, that channel tends to impact markets way more than it does the economy. And on the so that's the two components of monetary policy. And so when we look at those two components, neither of those components are necessarily going to be supportive of activity or markets, right? Now, when we look at the fiscal side is just the treasury. And what the treasury does is they borrow money and they spend it into the economy. And so, there are two impacts. There is the impact of how much money is being spent into the economy, which is directly stimulative to the economy. And so the more money that they borrow, the more they spend in. And so effectively, it's just a redistribution of money from the private sector into other areas of the private sector. But net treasury spending tends to be a support. And so the other component of treasury spending is the composition of their issuance. So when the treasury issues securities, they can choose to issue short duration securities or long duration securities. And these short duration versus long duration securities end up having an impact on asset markets, because the treasury and the government's liabilities are the private sector's assets. And so the more short duration securities that are issued by the fiscal authority, the more liquidity you have in markets, allowing, more risk taking to be underwritten. And so, what we're seeing is like we're unlikely to see a very, very strong fiscal impulse coming from the government. We have seen a good deal of fiscal impulse improvement over, let's say, Q3, Q4 of 22, but that support to both GDP and liquidity is waning, right? Like, so if you look at issuance is reduced, the projected deficit is not exceedingly large. And so when we combine all of these things, we do not see a policy environment that is very supportive either of the economy or of risk assets. Now, this basically covers what governments can do for markets and the economy. Now, the other component of the, when it comes to assets and credit creation and things like that is the private sector. So, you have two types of assets, essentially. You have government assets and you have private assets, right? So you can think of one as money, you can think of the other one as credit. And so when we look at what has happened in 2022, the government's extracted both liquidity from the real economy, right? So the government's actually ran a surplus in 2022, Q1, Q2, and they also extracted liquidity from markets, which was, a very difficult environment. But given the amount of the explosion in prices and the amount of nominal activity that we had in the economy, companies were actually okay to lever even as rates increased, because prices and nominal activity outpaced interest rate hikes. So you actually had so we track balance sheet activity across sectors and across various institutions and things like that. And so when we look at leverage going into spending, we actually see that the amount of leverage provided by banks actually increased in 2022 quite significantly. But, if we go back to, the component that we first talked about, which is interest rates, as those interest rates stay high, it's unlikely in the face of declining nominal activity that we can continue to have the same amount of leverage that we have today. And so while credit creation was supportive of, the activity we saw last year, it's way less likely to be supportive of activity in the future. And that kind of sums up.
Thank you so much for that great explanation going over the various policies. Yes, this rise in the cost of debt with rising rates definitely affects that higher leverage. And, I want to go back to one of the points you made about the Fed funds rate, 5.25. There seems to be a lot of chatter that many think that the Fed will be cutting rates in 2023. I am not in that camp. I believe that we'll probably be seeing a pause in the next, maybe in the summertime, maybe early summer, the next few Fed meetings. And then unless we have a severe recession of some type, I don't see rate cuts coming this year. What do you in your system show? Do you think that's likely, or do you think that it'll probably remain over 5% Fed fund rate this year?
I think that first off, we don't have visibility on the whole year. That's just not how we kind of take views on things. But what I will say is that it is unlikely that in the face of a mild recession with modest to elevated inflation, that the Fed changes its course based off what we have heard from Powell so far. And so I think what is going to matter is, first off, do we get a recession to materialize over, let's say, the next 6 to 9 months? And second, I think how much of that recession comes from labor, right, is going to be important. So how much of it comes from reduced spending versus how much comes from labor is going to be important. And the more that we have it come from labor, the more impact that it's likely to have on inflation. Now, if we enter a period of pretty significant deflation, right, like strong deflation, and we have a situation where, we're in recession, right, that is an environment where you can, start to crystallize those cuts. So far, I would say that the way we're tracking, we don't have a severe contraction on the cards yet. We have the initial conditions required for a contraction being met across many components of the economy, but these are only the initial phases that lead to a contraction. So I think that when it comes to my own personal judgment of these things, what I would think is that we are likely to be in an environment where, policy rates are held stable until something looks like outright very severe deflation. And part of this is going to boil down to the Fed finally having to make a choice, right? So I think one thing that needs to be noted is that so far the Fed has talked very tough, right? But they haven't had any trade-off yet. So the Fed has, they're in charge of employment and they're in charge of inflation. And when you have a stagflationary kind of environment, you have to make a choice between the two. You can't save both at the same time. So to hurt inflation, you usually have to hurt employment, and vice versa. So what we've had so far is you've actually been able to, for various reasons, get a little bit of disinflation without actually having to compromise on employment. Now the question is, if, as we expect, we're going to see more softening of employment and potentially contraction of employment, what is the choice the Fed is going to make at that point. So far, they've told us that, yeah, we're going to choose to break inflation, but it remains to be seen, how resolute they're going to be in the face of that.
I love that. Yes, there are absolutely so many moving parts, and they're always in motion and they're always changing. It's a permutation of all these factors, creating new scenarios. And I think that's why we all love macroeconomics and find it so fascinating and exciting. We're always learning every day. I want to go into the next topic. You mentioned the word recession, and I like to go into the potential earnings recession. And then we're going to go into the three conditions that Powell has mentioned continuously. And those are inflation, labor market, and growth. And he specifically stated, and I'm saying this off the top of my head because I think I've recited this many times, he wants to have clear evidence of inflation headed to 2%. He wants to see softening of the labor market and that we have below trend growth. So let's begin with the economic machine and how it's moving to put increased pressure on business profitability, and that apparently affects their bottom lines. Profitability is key. And the potential earnings recession. What are your thoughts amidst all these compressed margins? We know we have higher costs of capital, debt, production, labor. Productivity is down. There's a dilution of value. Do you and your systems foresee earnings recession this year? What are your thoughts on that?
So yes, we do. And I think that maybe, to contextualize a little bit how we think about, profits, and then maybe we can talk a little bit about the broader cycle. So profits, the two ways to think about profits. So the first is just to think of it as a function of top line. So say, if you assume that top line revenue growth is roughly consistent with GDP growth, which it has been, profits have to take a certain chunk of that pie, right? They take a slice of that pie. And so, as GDP scales or it scales down, you have profits go up and down. And that relationship's pretty straightforward. So if you have less nominal activity, you're going to have less profits. That's so, we know that we're having less nominal activity, which means that there's probably a net pressure on profits. Now, the second component is how much of that aggregate GDP pie do profits take away? And that's a little bit more nuanced. So what you have to think about in this case is that profits are they're an excess, right? Like they're a macroeconomic excess that's created from imbalances between sectors. So for businesses to profit, somebody has to dissave, which means that for a business to profit, a household has to spend more than its income, right? Or there has to be a change in the balance between those two. And so when you're looking at profits, what they really are is just a function of what other entities in the economy are doing. So those entities are the government, the foreign sector, businesses themselves, and households, right? And so based on these variables, you determine how much of the GDP pie profits are going to take. So everyone's basically just fighting for a slice of this GDP pie, and depending on what the pressures are, you net out to a certain profit number. And so when we look at things through this perspective, what we see is that one of the major sources of profitability and one of the major drivers of future profitability is businesses' own reinvestment. Because, if businesses reinvest, they essentially invest back into aggregate businesses. And it also creates an asset, which creates income in the future. And, there's a self-reinforcing kind of positive cycle. Now, when we look at what happened to business investment over the course of, let's say, 2022, late 2021, we started to have a significant slowdown. And now we are actually in contraction by our estimates in aggregate business investment. And that number was actually one of the biggest supports to profits in, say, like early 2021 and 2020. And so the biggest drag on profits right now is businesses' own reinvestment to create output in the future, which is consistent with a shock to the cost of capital and extremely high inflation, which kind of bars your ability to reinvest effectively. Alongside that shock, we also had governments reducing the amount that their deficit was. And what that does is, if the government runs a surplus, there's basically less, potential for profits to be there, because the government's deficit ends up being the surplus of the private sector. And so in Q2 and Q1 of 22, governments actually ran surpluses, which meant that there was a massive drag on profitability. And this came alongside an investment number which was massively declining. Now, the government portion actually improved in Q3 and Q4, but the investment number continued to worsen. And so what we have now is a situation where the only thing that is really supporting business profitability is the spending of households, right? And what is a big question is whether households can continue to reduce their savings at a rate at which they've been doing so. And, to kind of contextualize this, household savings rates are at historical lows. And, I don't remember the number off the top of my head, but it's somewhere between 3 and 4%. That's where the savings rate is. So what you need now for profits to continue on this path of expansion, even though it's very small and the growth rate is not, anything to write home about, is for households to keep spending more and more of their income, which is becoming harder and harder as aggregate income continues to decline. And so there's a high likelihood that, looking at the drivers of profits, there's an over-reliance on household consumption in excess of income to facilitate profitability, given the fact that we have rising interest rates and a declining growth environment. And so when we look ahead, it's highly likely that we're going to see profits start to move into contraction. Now, why does this matter, right? What ends up happening over the course of these cycles is you usually have some sort of shock to the cost of capital, right? And what that does is it creates profit pressures. These profit pressures, result in lower business reinvestment, which we've begun to see, right? Which also spurs in the future less profitability, which we're also beginning to see. Now, what ends up happening as you progress through the cycle, and this is the part of the cycle that we are probably moving into, is when this profit pressure becomes enough for businesses to start laying off employees, right? And so if we go back to the original discussion where every entity takes a piece of the GDP pie, if profits are in contraction, what businesses try to do is they try to claw back a piece of that pie by laying off labor, because that's, they compensate labor through wages. And so when they do this for a single business, while it might make sense, in aggregate, what it does is it just strips out a very large portion of economic activity. And so you remove somebody who is a worker, who is also a customer, and as a result, you have essentially a very big line item of GDP disappear because a business laid them off. And so what that does is it takes aggregate economic activity down, which actually reinforces the profit slowdown. And that's the part of the cycle that I think we're navigating. We've seen the initial stages of this profit weakening and potential contraction. And now what is likely to transpire is that as corporations attempt to shore up their profitability and, reduce the amount of labor, that's actually going to have an aggregate impact that's going to be deleterious to profitability and overall GDP, which is what catalyzes the recession.
Exactly. Perfectly said. Thank you so much. I know we discussed in the past how wage growth actually fuels nominal spending, which further drives nominal demand into some type of loop. And it appears at this point we are in a different loop, a potentially very disastrous loop for profitability, as savings are decreasing. We have credit card debt rising, higher interest rates as well on that increasing debt. And we have potential factors that are upcoming, such as student loan forbearance ending, EIDL loan and repayment, as I mentioned, credit card debt rising, potentially health. I think it's the post-COVID, some benefits are ending and people are going to be looking for health insurance. Business loans are set to resume. My point being, lots of bills are coming due for people. And when bills come due, it cuts into people's consumption. And as people cut back on consumption, businesses will feel that pinch even more. And that will cause them to have further layoffs. And as you said, the layoffs will contribute to less consumption because these people are out of work. And it seems like it's almost like a spiral in the other direction, which is very concerning. What are your thoughts on the labor data you've been seeing? I know we have a strong labor market right now, but looking at all these moving parts like we both discussed, do you foresee that in the next maybe 6 to 9 months, we could see a significant rise in unemployment or other labor data that will show a severe softening of the labor market?
Yeah, sure. So before I get into labor data, maybe since you touched on it, I can talk a little bit about the consumption aspects that you brought up. So
please do. Please go into consumption. Thank you.
Yeah, I think that when you look at consumption spending, right, most of consumption spending actually is, other than certain pockets, is financed by employment, which is why we'll segue into employment, obviously. And so a lot of that spending comes from just income, but you also have a component of income which is saved, right? And that saving is usually a function of what households are experiencing in terms of an income impulse. So, is their income accelerating? Are they, is their outlook for the future good? Or are their debt service payments rising or falling, right? So if you put those three together, you roughly have a good idea of, whether a household is going to save or dissave. And so what we've had so far, in 2022 is a situation where the income side of it was accelerating very strongly. And, net worths had begun to decline a little bit. But so incomes had accelerated, but at the same time, borrowing had also accelerated. Now, what that resulted, right, is in a savings rate that continued to decline. People felt the need to save less and less because their incomes were rising, so they kept spending. And the thing is, the problem that we're going to start having is that incomes are no longer accelerating. And if we look at household net worths, which we track on a monthly basis, you'll actually see that as borrowing has increased, households' asset values have also declined, which means that their net worths have also declined, right? And so you're approaching a situation where you have generationally low savings rates, you have declining income, and you have net worth, which is also declining in the face of rising liabilities. So the combination of these things just do not spell out that we are going to continue on this trend of generational reduction of savings rates. What we're probably going to have is, at worst, a stabilization of those savings rates, or we're going to have some kind of uptick in those savings rates. All of those things don't really bode well for total spending into the economy, right? And that's essentially the pressure that's on consumption, that the aggregate picture of the consumer that we track isn't a very good one.
Interesting. Thank you so much for that. Seems that we have a lot of potential upcoming shocks to the system. You mentioned contracting output and a declining inflation. However, I love the term you use of inflation stabilization. And let's clear that point up. Before we get into the labor market, I just want to clear that point up. Many people may think it means we're headed back to 2%. And that is not what we're saying here. And inflation is very sticky. And the services especially are very sticky. And they are a function of labor and employment. And we do have a very strong labor market for this time right now. However, things can always change in 6 to 9 months or 12 months. But as of right now, we have a very strong labor market. And so we have many components that are sticky. Could you please explain to us your meaning of the stabilization and what your thoughts are and what your systems show for an inflation level probably more likely than that return to that 2% in near term?
Right. Yeah, absolutely. So I think that this is a very good point, and I think it's an important thing you're highlighting. Just because we're talking about disinflation and disinflationary pressures doesn't mean that we think that inflation is just going to disappear, right? And so I think that it's important to recognize that inflation starts with an imbalance between the amount of money and credit versus the amount of goods and services. And that shock can come from one of two places, right? Either you can have just an explosion in money supply or credit or something like that, or you can have a shock to the amount of, goods and services. And so we had both over the course of the cycle, right? First, we had an explosion in the amount of money relative to the amount of goods and services. And you did have a shock also to the amount of goods and services. And then we had, geopolitical events that actually create a further shock to, to the amount of goods that were available. And so those impulses, right, that shock creates the conditions required for inflation to work its way through the supply chain. So usually what happens over the course of these cycles is that you have some kind of supply shock or demand shock. And over time, that supply shock, which usually starts somewhere in the goods sector, having to do with energy or energy-related commodities, works its way through the system and ends up in services. And then services begin to command a higher rate of inflation, right? That impulse has faded, right? And so when that impulse fades, over time, what you have is less of an impulse for inflation to increase, in a volatile fashion. That doesn't mean that inflation can't happen at an ongoing clip. So, if we say inflation is at 4%, inflation can stay at 4%. But the initial conditions that are required for inflation to jump from 4 to 8% no longer exist, right? And so when we think about that in current context, what we're really seeing in the economy when it comes to inflation is that you have two completely different economies effectively within the broader economy. You have the goods economy and then you have the services economy. And so the goods economy in many areas, because of the dynamics that we've cited related to corporate profitability and related to investment and growth, are experiencing declining activity and thus now even deflating prices. On the flip side, you have the services economy where the labor market is still extremely tight and inflation has already made its way into the pricing of services. So we can expect kind of a stable rate of inflation in these services areas until, labor market conditions dramatically change. The confluence of these two factors creates, a pressure that nets out to a much more stable level of inflation relative to what we saw in 2022, where both of these items were just exploding higher. And so what we're looking at is, a situation where you have something around an inflation mean of, let's say, 4%, maybe 5%. But that inflation mean is likely to be way more stable than 2022, which has much more impact and a meaningful impact on markets than, it does for anything else, right? And so what we're thinking when we talk about disinflation is really that inflation is likely to compress into this band, which is going to be a much smaller band than it was in 2022, and that's what markets are going to care about. We're not saying that inflation is going to disappear.
Exactly. Well said. Thank you so much. And yes, inflation is cumulative as well and works both ways. It not only affects the cost of goods sold, the operating expenses, but also the revenues, which are being held up by higher prices due to inflation rather than higher output and volume. So there are a lot of issues regarding that. But thank you so much for explaining that stabilization statement. Let's move on to the labor market, which is key to inflation. And I know we've been saying how there's been layoffs and they most likely seem to be continuing if the business's profitability continues to be affected negatively. But with this strong labor market that we have right now, it seems a recession is way off. What are your thoughts regarding the recent data we've received with this strong labor market and your thoughts regarding it in the near future and the concept of the potential recession involved with that as well, please?
Yeah, so this is probably the most important part of deciding where we go next in the cycle. And I think there are two levels to this. There's the first, which is the top line of it, right? The top line is essentially this: like, to begin a recession, you do not need the labor market to contract. So if you actually go through very many recessions, you don't actually see like year over year labor market contraction. You see quite a bit of softening, and then maybe towards the tail end of the recession, you actually see a contraction. So the first thing is that you don't need labor markets to contract, because spending is a function of the number of hours worked times the prevailing wage rate times the amount of people employed. And so if the first two components, which is the hours worked and the prevailing wage rate, contract in enough to offset the existing number of employees, you can have contraction even without employment in aggregate contracting, right? So that's the first one. The second thing is more about the composition of the labor market and what happens during a recession. And so when we actually look through what drives the labor market into contraction, there are a certain segment of industries. Now, if we wind back a little bit, there are, two different forces happening in the economy between the goods and services economy. And why that distinction happens is because certain industries are far more impacted by the cost of capital than other industries. And the reason that they are more impacted is because they are inherently more levered. So if, both in terms of their production and their consumption. So a great example of this is housing, right? Housing is a sector that has a lot of leverage that goes into housing construction, and also a lot of leverage that goes into the purchase of housing. The same thing can be said of automobiles or other durable goods, lots of other, other goods in manufacturing. So when it comes to plant and equipment manufacturing and things like that. And so when we look at what's happening to the activity in these leverage sensitive sectors of the economy, they are starting to weaken quite a bit. Now, why is this important? It's important because when we look through history to see what drives a labor market contraction, it is almost exclusively these cyclical industries. The broader industries, things like professional and business services, things like, tech employees, those things contribute to employment and expansions, but they do not drive contractions. In fact, a lot of those industries never contract even in a recession. So what you need to see to actually see a contraction in employment is a weakening of these cyclical sectors in terms of their employment. What drives the weakness in these cyclical sectors' employment is a weakness of the income in these sectors. So you have a decline in their nominal incomes, but what the purpose of employment is to create output. And so when we go through our data and we aggregate what is happening with the output in these sectors, we see that these cyclically sensitive sectors are actually in contraction in terms of their output, which means that the employment is highly likely to follow because output is contracting, which means that the purpose of this high level of employment is simply not being met. And when we look through history, within about 6 months of output contracting in any of these industries, you tend to see contractions in the employment in these industries, which coincides and causes the deterioration in the aggregate labor market. So what is likely to happen with the labor market is that as the pressures created by tightening begin to pass through, and they already have, and they worsen, we're likely to see layoffs in these sectors, which will drive aggregate employment lower, which will also drive aggregate spending lower, which will, create a self-reinforcing cycle into a recession.
Exactly. Well said. As I was mentioning before, it's like that cycle. It's like a loop on the opposite way of what we had, like you said, the mirror image. So we're getting the loop in the mirror fashion. So thank you so much for that excellent explanation. I think it's a perfect time for us to bring up GDP and the GDP contraction. Quarter four, I think it was 2.9%. It was not so good of a number, especially when we look under the hood, which is so important. We see imports weaker instead of having stronger exports. Looks like lower consumption and demand is continuing. What are your thoughts through your analysis, or what are your systems seeing with this GDP, and what's going on with that, please?
Yeah, sure. So if we look at GDP, we basically, we break down all these components, and we actually track each individual line item within GDP, which gives us a pretty granular understanding of how these conditions are evolving. So I think, to touch on what you said first, I think it's important to recognize that the trade balance has been a net support to GDP, which basically just means that we've been exporting more than we've been importing. But the reason that's happening is not necessarily a very good one. It's because our imports have decreased far more than our exports have decreased. So if we look at our total trade volume, that's actually declined. And both of those things, so our exports decreasing is actually pointing to, weakening of industrial output. And if we look at our imports decreasing, it's pointing to a weakening of consumption activity. Aggregate trade activity is declining, which net doesn't actually bode that well. So if you look at times in history where, trade is the biggest contributor to GDP, it's usually during contractionary periods. So the trade balance doesn't augur that well based on history for what GDP is currently doing. We look at government spending. Government spending has ticked up a little bit, as I described earlier, in line with kind of the deficit story. Investment activity remains the biggest drag on GDP, and our latest estimates actually have shown for a few months have shown real investment in contraction, and we actually now see even nominal investment in contraction, which bodes really poorly for profitability. And then finally, the stronghold of the economy, which is related to labor, is consumption spending. And consumption spending is being driven by the combination of labor and reduced savings rates. And so the pressure that is on now is on consumer spending and labor markets, which, if they soften, are likely to push GDP into contraction, which we think is pretty probable. And now, if we go and look at, get a little bit granular in terms of our tracking, when we look at the most recent data in terms of retail sales and personal consumption, we actually see that happening over the last couple of months. And so if this trend continues in retail sales and consumption, we're increasingly likely to enter an environment where aggregate real GDP growth will be in contractionary territory ahead of the labor market softening materially.
Very nice. Thank you. Actually, not very nice, but it is the reality of what it is. So thank you so much.
It is what it is.
Yes, exactly. GDP is bloated with that higher government spending and lower imports. So yes, once again, the next 6 to 9 months are critical in knowing what is to come at the end of this year into next year. So many moving parts. I have to say, these are exciting times, a lot of uncertainty. But I do believe that through the challenges, there's lots of opportunities upcoming. So I like to always remain positive with that. And with that positivity in mind, I think we should discuss one more topic, that is stagflation. Not necessarily a positive, but it is what it is. What are your thoughts with looking at your systems with stagflation being a possible likely outcome? And if it could be an outcome, what type of time period would you anticipate we could expect those conditions?
So I think that one, it's very hard for me to say anything beyond our forecast horizon, which at the max hits 12 months, but that's only for a few things. I think that what we have to think about when it comes to stagflation is what are the asset allocations and what are the prospective assets that can survive in that environment, and to be proactively prepared to allocate and switch into assets like that. So, assets like treasury inflation protected securities, gold, commodities, things like that. And from where we sit right now, we don't think that markets are likely to price stagflation over the next 6 months. It's possible that markets price some degree of inflation resilience and the fact that, maybe rates get, they extend a few more hikes that are currently priced. And we, instead of having cuts priced, we start having, a higher for longer pricing, which is a net going to be a drag on every asset, right? So it's not going to be a stagflationary pricing, because every asset will suffer as liquidity is withdrawn and expectations of liquidity are withdrawn. And so when I think about stagflation, I don't think so much about it as the most immediate outcome. I think about it as, if we move into that environment, you have to be prepared to be able to deal with it. But the way conditions are lining up, there is very little impetus for a massive reacceleration of inflation, which would really result in that stagflationary pricing. So for the time being, we actually have views that what is probably likely to dominate market pricing will be this disinflationary pricing rather than something stagflationary.
Perfect. Thank you so much. And with that stagflation point, let's touch upon the yield curve inversion. And there's a lot of talk about people saying how the steepening of the yield curve is a precursor to a recession or a stagflation environment. and it still can be a ways away. And it's not necessarily a predictor of it occurring tomorrow or in the next few months, but could be much further away. What do you see with this steepening of the yield curve with the short end? And that appears to be where it is steepening the most, rather than the policy rates easing the long. I believe it's more the short end. Could you please explain that whole phenomenon and what you see going on over there in the next 6 months or so?
Yeah, so I think that this you're referring to our month in macro report, and the yield curve is a fairly well accepted, let's say, predictor of recessionary activity. For us, what we're really looking at is less so the recession creation aspect of the yield curve, but more so, does an inverted yield curve point to bad returns for bonds? And the reason we look at this is because that a lot of institutions usually require some degree of steepness to the yield curve to begin allocating meaningfully. But what we've seen in history is that yield curves don't actually steepen based off what happens at the long end. They steepen largely based off what happens at the short end. So if we decompose the yield curve into the long end and short end components, and we actually look at periods of time that, yield curves have inverted, and after they've inverted, they begin to steepen, the principal driver of that steepening is not what happens with, say, like the 10-year or 30-year bond, which is the long end. The principal driver of that steepening is an eventual reduction in short end interest rates, which is usually consistent with a recession. And so what we're seeing is that as we get into kind of this disinflationary territory, and the economic machine continues to put pressure on aggregate activity, and we potentially move into a recession, there's a high likelihood that yield curves do steepen as we move into recession, but it's not going to be because of the long end shooting up. It's likely to be because of the short end coming down, because a recession has adequately hurt inflation and policy rates are being cut. And that's really what we're trying to get at, given the fact that, we expect this disinflationary impulse and we're actually positioned in bonds. So long story short, what we think is likely to drive any steepening of the curve is going to be the short end, which is consistent with history.
Very nice. And it's very important to make that point, because there's, two parts to the equation. It's just like how we discussed with the trade balance, how it's actually that the imports are weakened. So it's important to go under the hood and look inside that formula. And the same thing with the steepening of the yield curve. We see it has more to do with the short end, meaning the shorter term rates, rather than the long term rates, like you said, the 10-year, the 30-year actually rising. So great points. Very important that people are aware of that. So, I think it'd be perfect for us to go into the various asset classes. And most importantly, the Prometheus ETF, which you recently launched, and congratulations on that.
Hey, Rosanna, sorry to cut you off. I think I'll just clarify for the audience. This is our ETF portfolio research. This is not an index. So, those looking to replicate our ETF portfolio research can do so in their own PAs, but I just want to make sure, people aren't looking for a ticker somewhere.
Oh, no tickers here. Just the Prometheus ETF. It's so generous of you to be sharing your research for true democratization of macro for all people. And that's exactly what Prometheus symbolizes in Greek mythology. And we appreciate that. And with that in mind, we also appreciate how you share your ETF core objectives, not a ticker, just your research-based ETF allocation. And so I'd like to just have you please discuss the three major principles of your pro-cyclical approach. I love those terms that you use. Could you please explain those principles with what exactly you mean by a pro-cyclical approach?
Yeah, so I think that there are really three things to keep in mind, right? Like you said. Or maybe we can actually just touch on the pro-cyclical approach, right? So what we mean by a pro-cyclical approach is that markets tend to discount probabilities as they evolve. And being allocated correctly with how those probabilities are evolving ends up creating a return stream that's far more stable than taking outsized bets on the market being completely wrong about something. So what we try to do really with our portfolios is we're trying to create durable and reliable return streams that are not excessively volatile and don't have large drawdowns, right? And so what you want to do is you want to allocate in line with the way the cycle is moving. So if you're moving into an economic expansion, you don't necessarily want to be shorting equities because equities are expensive. You want to be riding the wave. And so you want to be there for expansions, you want to be out for contractions. And what it does really is it creates a return stream that's far more reliable. And at the same time, it avoids potentially losing a lot of money by being on the wrong side of a trade, right? So we try to swim with the tide rather than against it. And then the last thing that, it really does is it allows us to essentially make outsized gains when consensus is very wrong about how the future is going to evolve. Because consensus typically tends to extrapolate current conditions into the future. And so if you have a pro-cyclical approach that allows you to maybe be marginally a little bit more right than consensus, you can both avoid large drawdowns and you can also create pretty large payoffs. And so that's really what we try to do with our portfolios. We try to create something that's reliable, responsible, and durable, and do it in a way that's in accordance with the cycle and reduces, minimizes the amount of pain that an investor has to experience.
You definitely want to minimize the pain. So thank you so much for that. And I want to go right into your current allocations, which have changed. Last time we spoke, now you've shifted more into the stocks and bonds accordingly, as we discussed throughout the show. First, I'd like to mention the asset classes. You have stocks, commodities, fixed income, and currencies and cash. And on your Prometheus Research website, which is a wonderful site, you share all this information and the various tickers that you utilize for investing in these asset classes. So let us go into your current allocation. And I see you still have a significant cash position, but then you have MBB, the mortgage backs, and the fixed income. And then you go into the commodities, and you have some commodities, gold there, and your ETFs. Could you explain the thinking behind this allocation that you have here in the ETF, please?
Yeah, absolutely. So I think that, for bigger picture kind of context on how we do this, right? What we look at is essentially three layers. We look at first, what are our expectations for how the economy is going to evolve over, let's say, the next 6 months? And we focus on three major areas of the economy with lots of different moving parts between them, but broadly speaking, the growth, inflation, and liquidity. And based off those things, we come up with our fundamental outlook for how we think things are going to evolve, and we update that outlook near daily. And from there, we move into what we call our market regime recognition, right? And what that really is us making sure that markets are beginning to price the moves that we think are going to happen. And it forms a kind of security, right? Because what we need to recognize as fundamental forecasters is that we can be really wrong about things. Even the best forecasters in the world are wrong 40 to 45% of the time, which if you actually live through it, that's a lot of being wrong. And so what you want is you want a situation where, you have an expectation. So, to couch that in what, we're currently seeing, if we expect inflation to decline, we need markets to show the beginnings of the pricing of that inflation declining, which allows us to ride that wave as it gets bigger. And then after we confirm with markets that we're beginning to see these incremental macro moves that we want, we go into what we call our timing tools, which is really just our way of being, as the name suggests, timely in our execution of particular moves. So we look for attractive entries and exits and trends and things like that to allow us to optimize on these views, which in aggregate creates this kind of pro-cyclical style of investing, right? And putting that, into today's context, what we really have on, so obviously, like there's a high cash position, right? So the high cash position is largely just a function of what's happening with volatility. And it's also a function of recognizing that, the primary driver right now of asset classes is what is happening to policy. And so any shock that happens to policy reverberates through every single asset class, and what we call tightening liquidity, right? And what's important to recognize about that is that when you have tightening liquidity and these policy shocks, asset correlations tend to be way higher, right? And so any diversification benefit that you have in your portfolio, say, you usually own stocks and bonds, there are no policy shocks, stocks and bonds are good diversifiers. But in an environment where policy is the number one driver, it impacts both stocks and bonds, which basically removes all diversification benefit. And as a result, to get to some degree of reasonable volatility, you actually don't need a lot of allocation to anything. So if you're allocated 100%, you're probably going to have more volatility when you have a policy shock kind of environment like we do now than you would have had, say, in 2013. And so that's kind of what drives the high cash position, right? The second component of it is the fixed income position, which is, fairly consistent with everything that we talk about, right? Where we expect growth to decline quite significantly, and we expect inflation to kind of compress, and we expect the inflation impulse to be weak. At the same time, what it's important to recognize is that you can't be completely certain about your growth or inflation bets, right? You can't be completely certain about which way you're going to go. So when we look at what we're expecting, what we really expect is that inflation volatility is likely to compress. And the combination of stocks and bonds is the beneficiary of inflation volatility compressing relative to growth volatility. So a combination of stocks and bonds weighted intelligently actually is the best expression of a bet on either disinflation or reduced inflation volatility. And that's currently what we have on. Just for context, we've been pretty good on this in terms of, mapping this change. We turned bullish on, disinflation assets, I would say around December 31st, right? And this is after having the mirror image, like you talked about last year, where we were actually long commodities and short other risk assets. And, from time to time, short all risk assets. And so, this is just a function of where we think the environment is headed. Looking ahead, there's quite a significant possibility that as growth volatility really picks up, we might exit stocks entirely and move into a full fixed income, cash, and maybe some gold position.
Very nice. And that actually leads me to my next question. How often do you rebalance and adjust? Is it on a monthly, fixed basis, or is it as your systems demonstrate major changes?
So we do weekly, and so we rebalance our portfolios weekly, largely just to keep some amount of consistency for the user, so that they can have some sort of set schedule of rebalance. Um, and that allows you to be adequately nimble and react to market moves as they happen, but it also kind of reduces the amount of turnover that you have of just trying to rebalance daily. So weekly has been the choice.
Okay, wonderful. And I agree with you on the cash position in times of uncertainty. Remaining liquid is always a safe bet amidst tightening liquidity. So that looks like a fantastic allocation that you have. And I'm looking at your site right now, and I see, yeah, you share so much wonderful information. And this ETF is purely for the benefit of the readers of your Prometheus research. And I'm pleased to see you have a pledge your support. I will definitely be doing that. You do so much for everyone. You are truly Prometheus in the modern day world, sharing this
Thank you.
fantastic macroeconomic investment research. So I just like to touch upon one thing before we get into your website. What do you have planned for the future, Aahan? Please share with us. What's the next step for Prometheus? Have you thought ahead that far? What are your thoughts?
For the time being, we're simply focused on bringing people the most comprehensive and best quality tools that we can. That's all we really spend our time thinking about. We want to create the highest accessibility and the highest content work that we possibly can, and we want people to be able to profit off this. And I can't exactly talk too much about the specifics of that, but we want people to be able to access the research and insights that we have in a very easy format for them to be able to apply everything and really deploy capital consistent with that. And a lot of that just takes a lot of work and a lot of building, and we're still in that process. But so there's a lot of stuff that we provide, but I can promise you that's only the start of what we think that we can do.
Absolutely. I see you have been generating alpha, and I see right here, I love your color pie charts and the asset class allocation. Right here, you go very much into detail with the various asset classes. And just currently for the listeners, as of this week, I think we're in the second week of February or somewhere like that, you have, like you said, 48.5% cash, and then stocks are about 17.38%. And we have fixed income at 28.26 and commodities at 1.46. Beautiful research that you do, and so grateful to have met you. I think we first met last year sometime, and we've been meeting up quite a bit. And I have to say, your research has significantly come along, and your website. And this is how people can stay in touch with you besides Twitter. There's prometheusresearch.substack.com. And you put out a fantastic, we're talking like a book every month in macro, about 30 to 40 pages, and beautiful graphs and very detailed. And this is all for free. It's all for free, giving back to the community and taking fire from the gods, or taking macroeconomics from the gods and from everywhere, and bringing it to the people. Thank you so much for your time today and your valuable research that you share with everyone. Is there anything I missed that you'd like to add, please?
No, that's everything, Rosanna. Thank you. That was a very generous description. I really appreciate you.
Thank you. And you're very generous with what you do. And please, I urge everyone to go to Prometheus Research's site and read his fantastic macro as well as his allocation, all completely free. So thank you so much for the time today. And I look forward to seeing you again. Maybe quarterly we can meet up and discuss the macro and the markets again. And until then, I'll be reading all your research. Thank you so much for joining us. And thank you to all the listeners.
Yeah, let's do it. Thanks again. It was great chatting.
Thank you. Take care.